Good afternoon and welcome to the TheoTrade afternoon video. I'm Blake Young. Today is April 11th, 2024, and we're going to talk about that average bond auction that sparked a weird reaction in stocks today. So as we're looking at this, we saw kind of a contrarian, odd behavior despite the data that we received. And a lot of the news media is talking about the 30-year bond auction today was average. I'm going to disagree with that, and I'm going to show you why I disagree with that. We may be able to argue that we had average demand, but we had average demand on higher yields. And based off what we saw yesterday with the 10-year Treasury yield versus today's 30-year, we saw a very different action or reaction. It may be that we priced everything in, but we definitely saw a different action than what we saw before. So let's take a quick look. This is the ZB, and you can see over this longer time frame, the ZB, or the 30-year bond futures, have been downtrending, recovered quite a bit, but have been downtrending since last December. Lower highs, lower lows, over and over and over again, pushing down to these lows today. And you might say, well, where's the counter reaction? Where's the weirdness that happened? Well, we saw this move down, and if we look at this from the low and compare it from yesterday and to today, we saw the market react by knocking 30-year bonds down after CPI and the 10-year Treasury bond auction. Today, we priced in another lower move, but then we sharply reversed during the bond auction. In fact, the bond auction occurred in this candle right here. So we went from the low of 115, we rallied up to 115.25, so almost an entire point, and then we drifted back down. So this reaction, this spike higher, initially was saying, hey, these bonds are fine. We have demand for these. We're going to push these up. We overpriced the weakness of bonds. But let's take a look at the bond auction itself, and then we'll come back and compare it to the 10-year. We could go directly to the Treasury to look at this, but I like this on the Forex Factory webpage. This is the 30-year bond auction right through here. And everybody's talking about the idea that we saw 2.5 bid to cover versus 2.4 bid to cover and saying, that's normal. We are fine. Don't worry about it. And that may be true as far as saying that was normal demand. But as we're looking at that normal demand, we need to understand why we demanded the normal rate of bonds. Why were there that many people willing to buy the bonds and getting 2.5 bids for every bond that was offered? And the biggest difference is we went from 4.33 to 4.67. That is a 0.34% increase in yields. So for the market to be willing to buy these bonds again, what they're saying is that we are buying these if you pay us more. Now let's take a little closer look and look at what the history has shown. As you can see, the previous was 2.4, the actual is 2.5, previous 2.4, 2.4, 2.4, 2.4, and you can look at these bid to covers, and when it goes up, that's theoretically higher demand. When it goes down a little bit, they can still say that's pretty average, 2.3 to 2.2. And we can go through and look every single month going back for the year and saying, yeah, these are normal, 2.4, 2.4, 2.4, 2.4, 2.4, pretty normal. We had some lower demands in December and November, but pretty normal bid to cover. Again, the difference is they had to pay a lot more. Look at the difference from previous to the next. March, 0.36, 0.33. In fact, they were able to get more demand on lighter yields. If we look a little bit lower, you can see 4.34, 4.23. Again, equal demand, 2.4, for lighter yields. If we go all the way back, when did we have this size of a step up? We don't have that kind of a step up in yields offered to get that kind of coverage unless we go all the way back to October of 23. So back in October, we saw 4.35% previous and a 4.84, so an increase of nearly 50 basis points. And that was on lighter demand, 2.5 to 2.3. So to get them to buy this, what they were doing is saying, here's the bond, and they said, nope, I'm not interested. And they say, well, what if I give you 4.35? Nope. 4.5. Nope. 4.55. Nope. 4.67. There we go. Now we have people willing to buy these. And so they had to increase that yield to make it of any interest for the buyers. So today, is not average. It was average demand, but average demand on the largest increase in yield since October. What that means is the cost to borrow is continuing to climb. The cost for the U.S. government to get the demand and people interested in buying or investing in the U.S. debt, they have to offer a higher and higher and higher rate. And this is the highest rate that we've had, as you can see. Outside of that, we're going from 4.67. Outside of November and October of last year, you have to go all the way back years and years and years and decades to be able to see any higher yield. So this is the second or third highest yield offered, and we're seeing a decline in demand. Now, what did we see yesterday? Yesterday was worse. Yesterday, looking at the 10-year, if you're looking at it from the perspective of the bid to cover versus the interest rate, we saw an increase of 0.39, so a higher increase in the yield, and we saw a bigger drop in demand, 2.5, not to 2.4, but to 2.3. So yesterday was worse. And you can see that 2.3 looking down the actual auction result. The last time that we had that low of a bid to cover, meaning the demand, is back in December of 2022. And we had that low when we were offering a 3.63% rate. So the difference in what we had to offer as far as yields and what we were getting as far as interested parties was worse than what we had in December of 2022. And we really don't have any examples of offering that kind of a rate with that low of demand. We can see that 4.61 was higher in October of last year, similar to the way the 30-year bonds were, but we were offering 2.5. Bid to cover was 2.5. And so yesterday was very bad, worse than what we saw in the other. And yes, we probably did price in a lot of that expectation with the 30-year bonds in the market yesterday. To review what we talked about yesterday, or what happened yesterday, this was CPI, and CPI data said hot inflation. And what happened? Bonds got beat up and knocked way down here, because therefore we're going to expect new bonds to remain high. Current bonds are going to decrease the demand. And then we had the auction and we sold off to here. And so the 30-year mirrored that on the way down and priced that in. And so today, all of this action that we saw in the 10-year was pricing in expectations of another miss in the 30-year. So we priced in the bulk of it. And then this move through here, I would argue we overpriced in the next move down. And you can see it kind of stabilized through here on the 10-year treasuries. But what was happening during the 10-year treasuries, or to the 10-year treasury yield, while all of this was happening? Let's go take a look at the TNX. And for some reason, the 10-year treasury yield just isn't pulling up. So let's go take a look at the ES and we'll look at where that happened, or what happened with the ES during that same time frame on the intraday. And I just checked that on multiple platforms. And again, I'm not sure why, but we certainly didn't see the same, we can't see the 10-year treasury yield move, but we didn't see the same behavior today like we did yesterday between bonds and equities. So yesterday, equities sold off just like bonds. They rallied back up here and then dropped again, but they did not sell off as aggressively as the demand for bonds went away and yields went up. If we were to look at the ES and look at the moves down and up through there, we saw the same pricing in with bonds, and yet when the bond auction ended and we saw average demand on much higher yield rates, for some reason equities took off. In fact, it was more dramatic on some of these other indexes. Looking at the NQ, there's your CPI, there's the bounce, there's the auction right through there, and we dipped down, but we didn't make a new low like bonds did. And after that, we priced in the 30-year bonds, but look what happens right as the bond auction comes out. Now that bond auction happened right here at 11:01 my time, so 1:01 Eastern. And we had already created higher highs, higher lows, but as soon as that bond auction came out, and it said, oh, apparently we have enough demand to continue to put money into the market and free money into the market reacted and pushed up equity, specifically the NASDAQ here, from 320 up to 500. And from the lows, 400-point increase off of having average demand but a much higher yield rate. And Again, I'm not sure why I can't pull up the 10-year Treasury yield right now. It stopped right after the market closed, apparently. But as we're looking at that move, this doesn't seem sustainable at these higher rates. In fact, what I'm going to be looking for is I'm going to be looking for bearishness in the Russell, because the Russell did not gain like the other indexes did. And you can see this mirrors almost perfectly what bonds did. In fact, if we were to look at this and layer over the bond, 30-year bond futures versus the Russell, look how almost precise and exact these moves are. The bonds are in the purplish color here, and the Russell's in the normal color there. And if I even move this down so we get the same dimensions, you can see that we made a high, we sold off together, we bounced together, we sold off together, and then overnight we could adjust that to kind of match that after the reaction, the response. And you can see we bounced, and then this is when we get that 30-year bond yield. We see the bonds recover off of the lows that we priced in a lower move, and the Russell did climb following the rest of equities, but hardly at all. In fact, if we look at that 1101 time frame, we bounced up here, we edged up a little bit higher. We saw about a 10-point move from the auction up to the highs, which is a lot different than 400 points off the low. And so the fact that we pulled back here and made lower highs potentially, this looks like the Russell is probably going to be the one that leads the way back down. If yields are higher, if we had to offer higher yields in general, then the bounce that we saw in bonds, which happened right here, and gave it back in the last hour and a half of trading, then we are likely to see lower bond prices tomorrow. We are likely to see higher yields in the 10-year Treasury yield and the 30-year Treasury yield, and therefore we're probably going to see the Russell struggle to move any higher off of these lows. Looking at the bigger time frame, if we go over and look at, say, the 1-year daily, and we focus on the Russell, which is the green and red candles, that bounce was nothing. In fact, I would argue that the Russell made lower highs, lower lows, and this bounce was just to retest previous support after it created this lower high, lower low pattern. So the Russell is looking fairly promising for bearish opportunities. If we're looking for bullish opportunities, I'm going back with the same things we've talked about before. Higher yields and higher costs to borrow are going to hurt the small cap and those that are leveraged up in debt, and are going to benefit those that have benefit from inflation. And we might start with something like DBC, Deutsche Bank's commodity fund, which is, or Invesco's commodity fund. It was originally Deutsche Bank's commodity fund, but the higher highs, higher lows through here. The little pullback today, it's a fairly flat day. And if we look at gold prices specifically, you'll see that gold did well today, despite the fact that equities were rallying and we saw higher yields, which can sometimes have a negative impact. Higher yields can slow down gold's price. It wasn't. In fact, we hit record highs again. So I'm sticking with what we've talked about for the last number of months. Long gold, long silver, long commodity prices, long agricultural prices, as I expect these to continue to hold up until we see inflation kind of reach a boiling point and see demand collapse. But until then, I'm leaning into these commodity prices quite carefully. And if we're looking at this, we'll also look at something like basic materials. You look at basic materials, XLB, and the little pullback today and flat trading today doesn't scare me at this point. I think we probably will see a bounce, and I'll be looking back to those specific consumer staple stocks that we've talked about over the last couple of days, which means I'm going to be looking at things like Ball, tiny pullback today, CF holding its own at support, and these are the ones we talked about possibly selling a put against to benefit from the directional move up. STLD is one that I keep watching as well, still dynamics, and the fact that we didn't rally today with gold, this could be partly a demand situation, but steel could be getting a better price here at this low, and I'll be watching for this to go back up. Additionally, I'm still paying very close attention to energy, and energy is holding near their highs as far as the energy stocks go, despite the little pullback in oil. And if we're going to see higher inflation, these are going to hold up and continue to hold up. As we see those interest rates push higher in the near term, watch for these to slow the growth, but not necessarily reverse these moves. So I still like Valero. Didn't move up very much today, so I still think it's an opportunity to be stepping into something like Valero. We've also looked at a couple of others, such as Schlumberger in the past. And there's some pretty decent premium that are coming into things like Schlumberger and some of these larger energy stocks. And the last thing I'll look at, if we're seeing rising yields, it will mean that the consumers will have less money to spend, and I will be trusting the consumer staples more than the consumer discretionary, which means stocks like Costco and Walmart could be those. We could do Procter and Gamble. I'm going to be looking at these to maintain and possibly collect some premium against these while we watch for these to stabilize and go higher. Whether directly in Costco, today was a good day for Costco, or if we're looking at the overall larger ETFs and indexes, I'm looking at this low support level and going to look at the option premium associated with each individual stock, knowing that if we are in the higher than 50% as far as implied volatility percentile, then I want to look at opportunities to sell premium to get into trade, sell puts or sell put verticals, and simply let them sit flat and pay me out 1 to 3% every single month over month. Currently, XLP is pretty low, but if you took a quick look at Walmart's in the 80th percentile, which means they're paying a lot of premium. It's not because of earnings are coming up next week. We still have a couple of weeks till that comes out, but we're paying in the 80th percentile. And if we're looking at this associated with simply selling a put at $60 on a stock like Walmart, they're willing to pay you 2.5% or about $1.50 for this short put for 1 month of time. And that's where I'm looking. That's where I'm looking with these rising rates and the weird behavior of the markets, despite the fact that we have rising rates and equal or lower demand for those higher rates. Well, that's going to do it for me today. Join me again next week and have a fantastic week.